Hello and welcome to this week's instalment of Nucleus Investment Insights. This week our attention turns to the rising need to consider investment opportunities overseas. Following the great pandemic of 2020, the global economy is entering a robust recovery. This new business cycle is not like those we've come across from the previous two crises, the global financial crisis and tech wreck. Those two crashes were led by the US and then the recoveries led by China. This time around, the crisis was led by China and the US appears to be leading the recovery. As nations regain their economic footing post-pandemic, the forthcoming Biden infrastructure package can be viewed as a triumph of policymaking that will lift both growth and living standards in the US for years to come, especially in the forgotten working classes. This, when combined with the imminent technological advances of the electrification of transport and increasing robot manufacturing, underpins substantial opportunity for the savvy investor. So where to look? Australia, whilst weathering the pandemic well, faces rising headwinds to trade as cyclical slowing of growth from our main trading partner lowers demand for our resources. Adding to this dark cloud is the prospect of dramatically lower traditional growth drivers like immigration and education. And so, looking offshore can bring salvation, with the caveat that, like all investment decisions, a considered and thorough approach is warranted. Today we'll look at the structural forces behind our view that for now, the grass looks greener on the other side of the pond. Joining us today to share his views is our Chief Strategist, David Llewellyn-Smith. Hello to you, David.
Hi, Tim.
And also here to share his thoughts on foreign opportunities and how they can be used in our portfolios, we have Nucleus Wealth's Head of Investments, Damien Klassen. Hello, Damien.
Hi, Tim.
Good to have you both on. Just a quick reminder before we get started, if you haven't already, please subscribe and click on the notification bell to be notified of when we go live or have a new webinar to watch, or follow us on your preferred podcast platform. We also ask if you'd like to take a moment to click like on the video now to help our show grow. And for those listening in live, feel free to drop in your questions in the YouTube live stream chat to have them answered along the way. Looking forward to some great questions from today. It's a big topic. So we'll jump into the agenda for today. So we're going to be having a look at the big picture of investing, a big picture look at the investing, sorry. Kicking off, as I said, with the structural forces, moving into then the cyclical winners and losers, and then having a bit of a run through the various asset classes and how we feel today's topic of international immigration and where the world currently sits relates to those. So with no further ado, we can jump across into our first of the structural forces, gentlemen. David.
Yeah, thanks, Tim. So behind what Tim's just described as a shift in growth leadership, which is really one of the key points to this thesis, away from China and towards the US for this coming cycle, is there's quite a large shift in the ideas that are running the global economy. For the last 30 years or so, liberalism has been the touchstone of policymakers worldwide, and it's driven, the huge ramp up of Chinese development as it liberalised its economy, and for many years liberalised its politics as well. However, while that transpired, Western societies saw, what you might almost call libertarianism creep into their policy making, such that it all became about personal greed, and it really distorted our politicians and degraded our own policy making capability. And you could argue this is sort of a bit of a reaction to the 80s and 90s where the policymakers swung too far the other direction in terms of too much government interference, and then as you had that sort of deregulation sort of sweep through and all these massive gains, and now we've just sort of extended that idea too far out the other side. Well, it's post-Cold War as well, isn't it? There was a kind of a triumphalism that swept through Western thought, perhaps captured best by Francis Fukuyama and his end of history thesis, where liberal democracy was suddenly seen as the destiny of all, and that was always a pretty preposterous notion, but it did capture, I guess, the zeitgeist of the time, and in that way, it was a very useful thesis.
Yeah, and the other thing, obviously, is that you lost your fear. In the 90s and 80s, you sort of had that whole part about, or maybe more the 80s, you had that whole part about saying we need to keep the poor people happy because otherwise they might revolt and go toward communism.
That's right.
Whereas that sort of almost got taken off the table.
Exactly right.
Yeah.
And so what we're seeing now is an inversion of those trends that developed over the last 30 odd years, where a whole series of different things have happened. We obviously had the rise of Donald Trump, which triggered, a great deal of angst in more centrist policy-making circles, as he has a right-wing populist, what I'm calling a liberal gangster, captured working-class votes in the US, and so that was a huge warning that policy really needed to shift back towards working classes and making globalisation work for households, not just for corporations and elites. And then, of course, we had COVID-19, which has been, a shocking blow to, the Chinese reputation, and more importantly, I guess, the Chinese system as an alternative to the liberal system that had been developing out of Western societies over the last 30, 40 years. The sort of bald-faced truth of it is that had China had a more transparent system, the pandemic may never have escaped its borders. So, we've all been through the various investigations and what have you into the causes of it, but I think that's a sort of a truism that we can accept, that they hid the pandemic for the first few months, and by the time, they got around to accepting that they had to face the accountability of the pandemic, it was already long, well gone and
Well past the borders.
And running wild. So those various factors basically have shifted, I think, the relative acceptance of liberal policy making worldwide, and so we've since then had the election of the Biden administration, which I think is capturing this new spirit of revived centrist liberalism, which is much more about national interest than it is specific interests. And we can see that developing, especially in its fiscal policy making, where it is doing a terrific job, in my view. It's got all sorts of fiscal stimulus coming down the pipe, about 4 trillion of it over the next 8 to 10 years. And it's a really good mix of human and hard infrastructure that the US has really neglected for many years. So there's heaps of investment into everything from healthcare to education and lots of long-term productivity drivers. And then infrastructure as well, which it needs to revive, plus all sorts of stuff to support onshoring of industry, in particular strategic stuff, semiconductors, all that.
Big review of all their supply chains.
All their supply chains, exactly. And so what they're doing is in a sense auditing globalisation and how it worked for them, and finding that it didn't work all that well.
Yep.
Quite frankly.
That's a good point.
Well, and it's probably that maybe that's putting it too fine. Maybe it's taking one direction, because it could certainly work very, very well for some companies.
Yes.
And I think there's parts where it'll say, okay, where.
You'll have to take this as a story.
Okay.
Obviously, there'll be a bit of license in various things, but I think there's a tipping point in there where they've decided to audit globalisation and found a lot of shortcomings.
Absolutely.
Yeah, and so they're pushing away from that, and specifically around China. Obviously, and that's the one great legacy of Donald Trump, is that he changed the China narrative very much for the better. And even though he was a gangster himself, in that sense, he might have said, legit liberalism.
Yep.
From this new alternative kind of centrally planned dictatorship model of semi-liberalism, or illiberalism, as we call it, which is a different kind of gangster liberalism, basically.
And maybe actually let's just sort of step into that gangster liberalism as well, just to sort of define what you mean by that, because it's a nice term, but it's
in effect, I think what I mean is liberalism distorted and captured by interests.
Yep.
So, the freedom that we all enjoy and that has driven so much economic development across the world for 30 or 40 years through innovation, productivity gains, etc., obviously that comes with a certain acceptance of inequality and greed. It's embedded in that system. So you might say it's got a fatal flaw, but what has usually happened or happened previously is that you would have policy weigh against those extremes to manage
The greed.
the greed.
Yeah.
Yes, just weigh against it, and that really dragged the anchor over the last couple of decades.
And you'd have regulators who would break up companies that got too big and
Well, you used to,
self-stabilise
yes.
sort of function.
But now, of course, they make the rules easier and then get a job at and the poacher becomes the regulator, becomes the poacher, and that kind of revolving door policy making has completely warped the principles of liberalism as they're practiced in Western economies.
And they often write the laws themselves. They go, here's a draft. We've done your work for you now.
Absolutely.
Now,
And in fact, governments, certainly here, and I think this is very clear in the Morrison government, actually don't know how to govern. And we've seen this time and time again over the Australian pandemic. Like, we'll just outsource it, to who? Like, to some security guards. Well, they caught it, in terms of quarantine. Like, they just simply forgot how to govern. And this applied to both sides of politics. Morrison government's a very good example of it, but I think you can see a good one in Labor in Victoria as well. And it was simply a case if you get in there, you outsource whatever you can, and then you go and work for the person that you outsourced to. So that's what I mean by gangster liberalism in the West. It was just an absolute greed fest of people that, in effect, were rorting the public purse and the commons.
Yeah, and you often bang on about the gas. And I like to think that's probably a key sort of example of it, where Australia's opened its whole gas markets up to the rest of the world and tripled our gas price for local producers, and everyone's there's all this sort of and consumers are all paying more and all that type of stuff. But the people who are really benefiting are a few big international gas firms. But both parties have had the same policy. To effectively, there are very minor differences between them. It's been a group effort to really push down this path, and there hasn't been that sort of any pushback on either side, because both sides are quite captured.
But I've failed horribly. But yes, that is a spectacular example. Which, if we do have any economic historians of note that bother covering Australia in the future, they will look back on that as a glowing example of policy failure. So that's Western gangster liberalism, and then at the same time, you have a kind of gangster liberalism, that transpired in emerging markets, and in particular China, where you have what is essentially a gangster group in the Communist Party. Running the country to benefit their members above everybody else, and controlling trillions. And
it's probably safe to say gangster liberalism is pretty common throughout history in emerging markets, though, as well. It's sort of the closest they get to a democracy is.
It is. And China has its own traditions, imperial traditions, etc. in this regard. But of course, there are still immense differences between that Chinese gangster liberalism and what we developed here, and Western societies did, insofar as we just have a hell of a lot more freedoms. And as we're seeing in the US, we can actually vote something sensible in. We had the US threw a grenade at Washington in Donald Trump. The working classes did,
and also literal grenades as well.
Yes. Then those that got thrown out, I think, almost tried to throw literal grenades, But then, that was enough. It worked. Like, it changed centrist policy making there, and in part due to the pandemic, but I think also just a decent campaigning and good policy from Biden administration incoming. They won back government and have both houses, and so the US has pivoted dramatically.
But more so than that, they've got an impetus to actually want us to say we need to, if we want to keep Donald Trump out, we need to actually do stuff that helps the people who voted for him. And that poor working class that really suffered from losing their jobs to
that's probably a good segue into our next structural force. So the US does have to sustain much better policy for its workers and households, and that's coming to bear on globalisation and Cold War 2.0. So lots and lots of moves to ensure that US growth is no longer trapped in this where it's been for the last couple of cycles, where it effectively outsourced its industrial base, crashed its interest rates, inflated asset prices, inequality exploded, and then it went through a rolling series of financial crises as a result of just this crazy financialisation. And so that's going into reverse somewhat. I mean, don't get me wrong.
We've started down the path we could easily reverse at some stage.
Yes, that's right. And so lots of policies for, to strengthen its industrial base. And as we said, the fiscal package is terrific for all kinds of human and hard infrastructure, and technological change as well. Climate change is huge, and so they've simply pivoted towards a much more sensible set of policies that will support their growth over the long term, and moreover, I think, make a US style or renovate a US or Western style of liberalism for everybody else, as an example.
Yep.
And so that essentially segues with Cold War 2.0, started by Donald Trump and now consolidated by this new sensible policy making. So all those supply chains are going to come out of China. Well, not all of them, but obviously under pressure. And so that's the backdrop that gives you the essential conclusion for this coming cycle, which is the US is going to grow really well, and China faces, what it declared itself it faced 10 years ago, and that is a reckoning for its development model, which is running out of puff, and that's to largely the way that gangster liberalism has worked in China is in effect it's misallocated incredible resources and capital into wasted infrastructure and empty apartments.
But is the urbanisation's rising though, so there's obviously some benefit there. If you could call urbanisation a benefit, I'm not sure.
There's a kernel of truth to it, as all crazed cycles do, or bubbles, if you want to call it that. This is bigger than any sort of bubble, I think. But and it's gone on longer than I thought it ever would. Because it looked so unsustainable even a decade ago, and it's now, they're now building twice as much as they were 10 years ago.
And 10 years ago they had sort of 25 million-ish people moving into cities every year, and now it's under 20.
So that's the key.
It's the rate of change.
The rate of change. We're past the peak in the rate of change, and so the number of people they're moving every year for urbanisation is declining and will continue to decline. And so they're going to need less stuff. Less of these hard assets that they've built so much of. Now, they're getting, I'm sure, this will ebb and flow. They'll tighten on it, it'll fall, they'll slow too much, they'll boot, they'll kick the can again. We've seen this time and again. So don't get me wrong, I don't think they're about to suddenly
come to a crashing halt.
No, and radically change. It'll be more of the flight path down.
It'll just,
Yeah, that's right. As they hit the brake and then the accelerator. But at the moment, we're going into what I think will be a fairly determined set of brakes for the next couple of years.
And given the pivot the US is taking, and especially with some of the technology stuff, is that it's basically saying, well, if China's going to be throwing money at something to stimulate the economy, well, it used to be, okay, we're throwing most of it at infrastructure and housing to get things going. For the next few years, it's going to be a chunk of that's going to be thrown at R&D and semiconductor manufacturing and all those types of things that have been cut out of to try and bring themselves back up to
world class or
Well, traditionally, this is the next step in any development model.
Well, this is the middle income trap.
That's right.
It is. You try and add value, grow productivity, and lift your incomes and lift the the value of our exports over time, get away from the heavy investment model as it exhausts itself. And if you don't do it, you basically stop growing.
Yep.
Like you just bog down into excessive debt, which is where China's at. And so, as Damo says, the latest 5-year plan had enormous emphasis on tech advancement and some on climate change as well. And so that gives them a growth offset as they start to put the brakes on these traditional drivers that we've seen have really, really kicked along, things like commodities in the last 2 cycles. And of course, as we look at this right now, people will be saying, well, iron ore's nearly $200. Like, how can this possibly be? But we just see that as a short-term phenomenon. Most of those commodity prices, I think, are inflated on a cyclical thing. There's a bunch of drivers right now as the global economy opens up. You get this phenomenon called catch-up growth, where essentially you almost get 2 years of growth in one.
Yeah, right. Yep.
Demand just goes nuts, and at the moment, that's causing supply constraints. So
and there's been supply disruptions in Brazil as well.
And some of those as well. And so you've got these temporary large spikes in commodities. Some are arguing that the US growth push will be so large that it'll trigger inflation and keep these commodity prices high as a hedge, etc., etc. I don't buy that particularly. I think US inflation is going to be stronger, most certainly, but China's everything to commodities. And while it slows and this catch-up growth phenomenon lasts, say, 12 months, 18 months, and they're already tightening into that as well. So you're going to see, I think, a reasonably sharp slowdown in China when it probably looks like it'll start in the second half. But you can already see it dripping into various data points. And then I think it'll be distinct in 2022.
Okay.
So yeah, I mean, we're kind of starting to tip into some of the cyclical factors. So maybe I'll just quickly wrap through some of these structural ones, and we can come back to.
Yeah, so I mentioned before the technology is an interesting one. So I was going to say we had a chat to a guy in Canada yesterday for next week, and we can talk a bit more about that a bit later on. Just talking about the evolution of battery tech, isn't it? An energy aficionado, and it sounds like there's plenty going on in that space.
There is. I might toss to you, Damo, for this one.
Well, and robotics is the other big one. Obviously, is that so? There's a couple of things coming down the line. But Dave spoke a lot about the moving supply chains out of China, and the big reason for moving it to China in the first place was because labour was so cheap, and so some of it is ending up in other sort of cheap places like Bangladesh or Vietnam or other countries, but they're just not the same size and don't have the same infrastructure, and so other parts are then moving sort of back to countries, their home countries, and relying on automation effectively to get them, to bring the cost down to the level. And we've seen in Australia the fruit picking was a good example. That's Tasmanian one the other day came out saying, I can't get any more backpackers at over $15 an hour, and so I've had to shell out and get these roboticized apple pickers.
Yeah, okay.
And so it's that part about going, okay, well, once you've done it now, you're on the path.
You're not going back.
You're not going back. Yeah. No, that's right. And you see that with a whole bunch of different industries. It's the same type of thing. And in agriculture, it starts at, say, things like wheat and stuff like that, where it goes from people chopping it down individually to getting harvesters to more efficient harvesters to using GPS and all these things like that, and you just get fewer and fewer people all the way along the line,
and efficiency and scale.
Exactly. And then you move into the next one, and for a while there, fruit picking was one that was still heavily manual, but there are ways and machines to start to. But we were very much at the tipping point of can you afford it or can't you afford it?
Yep.
And you'll just start seeing those flow back into developed countries.
Yep.
And so that whole roboticization is one big theme. The electric vehicles is another big one in transport, and really driverless cars is a major thing coming down the highway, so to speak. And when that comes, it's hard to say. Google's got live taxis, driverless, no drivers driving in Phoenix at the moment. Yes, there are issues with snow and things like that they haven't solved yet.
Yep.
But it's very close. Whether it takes them another 5 years or 10 years or whatever to get there, but it's coming in the next decade.
Yep.
I guess at least in some areas, and whether it just means in cities. But the big issue for us there is it actually frees up one of the largest expenses everyone has, or certainly as a percentage of their income. Poorer people. If you're making whatever it is, 50,000 a year, and paying a bunch away in taxes, and so maybe you're taking home 40,000, and you're paying $5,000 a year roughly to run your car, and possibly 10 grand because you've got two cars. That's a huge chunk of your income. And if you can go back to one car because there are self-driving taxis that are very cheap and effectively the price at public transport prices, that could be a huge lift for global economies.
Yep.
But at the same time, it's going to be a huge loss of jobs for
That's right.
for exactly the Trump voter base. You know? And that's going to be a huge issue for economies making sure that they manage that transition and move people smoothly away and into better jobs.
Yep.
But so big issue, but huge gains in productivity if done right. Major issues with political stability if done incorrectly.
That's true.
So so there's those ones. What else do we have in that?
Climate change.
Climate change, and that's we'll a bit of a focus on that next week, but that whole idea that and we've put up a chart on lots of occasions that just sort of showing that solar power plus batteries is sort of our killer app in terms of at the right price that can deliver pretty much what you want.
Yep.
And the issue was that 20 years ago the price was 100 times whatever the price everything else was. Now we're getting pretty clse to even within Australia, which is why we're seeing this big rollout of batteries. So solar got there a few years ago, but obviously solar only works during the day, and so then you needed the batteries really to smooth it out. And that's now reached a point of parity in a lot of places, and it's on this technology curve, so it's only getting cheaper every single year. Whereas your coal and all those other factors are just getting more expensive every year. And so that's just it'll actually benefit, the benefit for Australia of having such high electricity prices on a global scale is that we actually start to see the benefits earlier first, because our energy prices are about double what you get in the US. So the US actually won't see this effect for a while, and they've got very, very cheap gas there, but they won't see it for a few more years after us. But you will see that just coming through where it's just a cap. If electricity prices can't double, because if they double, then everyone just goes and gets solar plus batteries, and it's all over.
Yeah.
And so
this is the hilarious sort of policy making of the coalition over the last decade. Where they came in and trashed the carbon price, and then fully endorsed a gas cartel immediately afterwards and throughout, which sent electricity prices to the moon. And in effect, they installed a gas cartel carbon price. Yeah. Right.
So all the carbon price was doing was increasing the price to the level where solar becomes, competitive with it.
Yep.
And what David's saying is we've effectively done the same thing, but
instead of the money being recycled into the budget and giving household tax cuts, it went to utilities who kept the money as profits and gouged households with high bills.
Origin and Santos and
so it was
Chevron
incredibly destructive policy. But anyway, yes, Damo's right. It will accelerate here really quick, and this is the one area, because Australian renewable assets are so good, they're really world class. Australia will benefit here a lot.
Yep.
And that will have some flow-on effects for some industry, like positive effects. But on the other technologies that we've been talking about, I think we can expect them to come last to Australia.
Yeah. Sure.
Well, already the EV we're coming. If we're not last, we're certainly in the world. We're certainly pretty close to last in the developed world
in terms of take up of EVs.
In terms of take up and just government policy behind it. We've already got the Victorian Labor talking about putting a tax on on these things where everyone else is subsidising them.
Yeah, it's fascinating actually. Well, just anecdotally, Tesla have done a pretty hard run into some major local government and areas like that. There's the fact where friends of mine have been given Teslas for the weekends and things like that to just trial them out. And a couple, I won't name names, but yeah, some pretty big, government organisations or quasi-government organisations, probably the best way to go. Yeah, not quite in the confines of state power, perhaps. But anyway, so it shows perhaps that if state government won't do it, the corporates will do it themselves.
Yeah.
Yeah.
Okay, so moving on, our next structural driver of stuff in this next cycle is, we've already touched on this, but the demographics question for China. It actually looks a little more troubled than anyone even thought, with new statistics, I think just last week, suggesting that the Chinese population may already be falling when it was expected to keep growing for another decade or so.
And certainly the working population is falling.
Well, that's been falling for some time already. So all of those analytical measures on population that make it that give you what is called the demographic dividend, where you just have you have very few government burdens and lots of young people make heaps of money. It turns on its head. And you don't have that many people paying taxes, and you've got an awful lot of debt burdens.
And a lot of that's the one-child policy, which goes from, as I said, the six-pocket theory, where you have two parents and then two grandparents on either side. So there's six pockets bringing up this one young child and helping nurturing them and giving them this great education and all this stuff. But then as they age, it turns the other direction, where you've got one grandchild with four grandparents and two parents to try and support in there.
Fair point.
And we already touched on the urbanisation, peak in urbanisation, which is past. Another demographic question. It's going to weigh very heavily. And if you compare Chinese demographics with the US is much better. Basically, China's demographics are very similar to Japan's. As they came into the 90s, we all know the difficulties that posed. Whereas the US is not perfect, but it's certainly considerably better. So that'll be helpful for household formation there.
Yeah, and it also gets into exactly that stuff we're talking about with the whole urbanisation part. China, yes, it'll probably still keep urbanising, but if you've got a falling population, there's obviously fewer people. Urbanising them.
Do you think China will go to a two-child policy, as in you have to have two children or more or something?
Well, they may, but it'll take 20 years before it does.
Exactly, yeah.
The UN population forecasts for China are that it starts falling in roughly 10 years. It may already be starting to fall, but it basically just keeps falling from here for decades to come.
Steep pig in the pipe, so to speak.
So I think they're 1.4 now. It ends up down about 1.1, I think, around 2050 or 2060. Right. I can't remember the specific figures, but this is why the urbanisation curve is, running out of rope. So next one up, and this will be no doubt our reader's favourite, the Australian satrap. In structural terms,
So just for those listening in, what is a satrap?
Well, it's like what we call ourselves a dependent ally.
An outpost.
An outpost
of a different culture or economy, obviously Australia has had that strategic role from day one, as being an outpost of the British Empire, more or less until the fall of Singapore. In the Second World War, at which point we, swiftly attached our barnacle to the rising US.
So we've got plenty of freedoms in the way of governing ourselves, but we've still got a rope attached to our necks to connect.
Well, we're part of what I call the you could call it the Anglospheric liberal empire, which had a leadership change. At some point, the last 200 years, over the 20th century, we had a leadership change from the English to the Americans, and we're certainly an outpost of that, most certainly. And it is an empire, I think that's important to note. Like it does enforce its rules. It's got a central power.
Levels expectations on its subjects.
Yeah, it does. Like
Yeah.
it's not a free lunch.
No.
And it punishes people who sit outside it.
Yep.
Like it can be quite nasty. Makes huge mistakes as well. Like it commits to wars it shouldn't. Kills people it shouldn't. But when you compare it to the alternative of an illiberal empire, which we've seen time and time again over history, and very much challenging the Anglospheric version at various times in the 20th century, they're pretty nasty as alternatives. So I mean, it's the best worst system.
Yeah.
So
It's a worst system of government except all the other ones we've tried.
yeah, that's right. So Australia, is an outpost of that. But the key point here is that we've spent 20 years toying with becoming a Chinese satrap, right? Economically, we allowed our values, put our values and our strategic position to one side, and said, okay, well, our economy's separate to that. We can just go down that path. And over the last 3 or 4 years now, that fatal straddle has torn our trousers in two, and now we've had to make the choice. We're certainly still exporting heaps of iron ore to China and other stuff, LNG in particular, but it's quite clear that there's a tear in our trousers that's getting wider and wider. And basically the Chinese are fed up with us because
they paid good money for our politicians.
They paid good money and they're not getting what they
We keep sacking it.
It was false advertising on our part. So and so we're going through this pretty accelerated decoupling from China. Now, at the moment, it's all being hidden by this short-term burst in iron ore. But
and the other thing that hides it as well is, and the huge benefit for Australia is it's all commodities. So, which are not all commodities. Sorry, a large part of it's commodities, which are completely fungible in terms of.
They are.
We've seen with barley already that, and when we spoke about this, 6 months ago, and here before, before.
That's played out almost exactly as forecast. All of those commodities that China blocked have just gone somewhere else. Prices dropped a bit, but they'll come back over time.
Yeah, Middle Eastern barley. The stuff that was going to the Middle East went to China. To China, Australia goes to the Middle East.
No, it's not the end of exports at all, but it is a decoupling from China that will land. There are a couple of areas where it will hurt for a while.
Yep.
And they're the ones that have been masked by the pandemic.
Yes. Things like wine and things have really struggled, but the future one is tourism and students.
Yeah, absolutely.
Like, they start to threaten just last week. The charming Chinese embassy sent out its wolf warrior and threatened that the tourists wouldn't come back. And I really don't think they will, quite frankly, because, I mean, at the moment, we're... For largely, I think, for domestic political purposes, the Morrison government has turned incredibly hawkish on China and especially Taiwan. And I think there's further blowback coming from that. And we've lost all of the tourists and students for now, and I just don't think they'll come back.
Well, and also as well, there's not a lot to
Certainly
lose.
not at scale.
Ex those two, there's not a lot to lose now because China's already said, okay, we're not going to accept your coal, we're not going to accept your barley, we don't want your wine, we don't want, like they've already played a lot of their cards in terms of this is what we're going to do to punish you, and so it's like, well,
Keep going.
So that's a structural change for Australia that will persist through the next cycle and get worse as iron ore, obviously, as this delightful iron ore boom deflates. And so we're reverting basically to our former position as a US or Anglospheric outpost in Asia, strategically. So those are the structural forces at work, and we've kind of covered it.
Before we go, maybe I'll hear a few questions.
And thanks to those listening in for providing some questions. We'll jump across to those. So just before we jump into the cyclical stuff, any thoughts on the global chip shortage and for how long? You'd like to address that one?
Yeah.
Looking at chip manufacturers recently?
Absolutely. Well, ever since we started, I guess we've sort of had a bit of an overweight to that sector, and it's extremely interesting. Convergence at the moment of political, science and cyclical issues, and like it's a microcosm of what's happening in the global economy, and especially the way I think the Biden administration is looking at it, and it's not just Biden, it's the Republicans as well. I think I think this is a bipartisan issue in the US. Is okay, they've let themselves get in a position for chips that they shouldn't be, and now they need to fix it.
Yep.
And part of the issue is that they have been very laissez-faire in terms of letting people do whatever they want, but the issue's been that Japan hasn't been like that, and South Korea hasn't been like that, and Taiwan hasn't been like that, and China definitely hasn't been like that. They've been supporting all these industries and pumping things in, and so you've got some countries really supporting this industry, and the US not supporting it, and so and the countries, and initially at the US it was all about companies cost saving and saying, yeah, I'll get my chips done in Taiwan, I'll get them done in South Korea, and save myself some money.
Before long, everyone's doing it, and you've got yourself a
well, and they lose the skill. Right. And they're trying to move up the chain, and you haven't got anyone in the US moving up the chain anymore. People have, they're shrinking the people that actually know stuff about this, and so they've ended up in that difficult position. So they're starting to flip back. The big issue, I think, for me in terms of the global chip shortage is, look, you probably got a little while to run on this, and a lot of it is just bounce back in demand and a change in demand as well in terms of what was being demanded. So I do think there's a while to run. I think you've got a few years before we sort of really clear it. But I think the next sort of 6 to 12 months at least, there's probably going to be shortages, across a range of different things. And a lot of it is just, the chip manufacturers, it's expensive. These things are very, very expensive factories, especially the high end stuff.
Yep.
And they don't want to be pumped. A lot of the ones that are short are actually the very low end chips. And these guys are sitting around going, well, just I can get $100 for making this one chip over here, and you want me to change my system over so I can make a bunch of $1 chips? Yeah, that's fine. I've got enough demand for the $100 ones.
That's right. As anyone who's trying to buy a graphics card at the moment will attest to, it's they're impossible. So
that's a Bitcoin thing as well.
Well, that's right. But once again, that's another factor that's playing into, I think, the whole tightness of the whole sector now.
Yeah. And the whole, working from home and other just structural changes that are happening within the economy is going to cause all these frictions. And I think there's that. When I'm saying it's a microcosm, I think it's a microcosm of what's happening in the whole rest of the supply chain as well. In that there's various places that are you've got supply blockages, not because people aren't willing to do it at that price, but the demand has shifted in the world because of shutdowns and pandemics and all those things. And so there's just not the capacity there. The capacity will come back, and there will be, there are people who are willing to make factories to make these chips at the cheap chips, but they still need to make the factories and get them to that stage. And so, so I think at least 6 to 12 months of this sort of forcing through that issues, and probably longer in terms of until you actually really sort out, where structural changes have happened.
Okay.
Having said that, there's probably if you go 3 to 4 years down the path, you're probably getting to the stage where you've got, Europe starting to set up a bunch of these things themselves. China's got, the US has got, I think, is it $100 billion? Ballpark?
The numbers in the US are phenomenal.
Yeah. So basically,
there's 40 from Intel, 20 from Samsung,
TSMC.
I think TSMC's another 20, and Apple's talking enormous dollars.
Yeah.
And that's just the headline numbers.
So this is money committed to building factories.
In the US.
In the US,
which is all part of this repatriation.
So it'll go the other way. We'll be eating microchips instead of cornflakes or something in 4 years' time.
Yeah, that's right. So there'll be a stage where you'll just be like, oh, where'd all these chips come from? How come they're so cheap? This is fantastic.
Once again, though, I suppose that lends it back into that technology push, because you've got the ability then, as things are expanding, that you've got cheaper parts to start plugging them all in again, perhaps.
Yeah. So that was that one. What were some of the other ones we had there? Australia. It's actually the Pavlovian response question. That's actually an interesting one. So the question is just talking about Australia. Budget deficit's bad, and we've been trained for basically since the Howard government got a budget surplus that they weren't expecting, and then they wanted to tell everyone that they meant that, and it's the greatest thing ever. That's a sign of a great economic manager. We've sort of taught the electorate that. I think what we're seeing in the US is the flip side, and also that was a certain extent the US politics went the same way in that. Democrats equal bad deficits and Republicans equal
surpluses.
Yes, well, at least
paying down
restraint.
debt,
But then
at least small government.
but then Trump arrived and blew out all the debts with massive tax cuts, and so obviously it's harder for them. But the US is certainly down the path of deficits aren't necessarily bad. Australia, I don't think's quite got there yet. But we're close.
COVID's opened up a massive hole.
Well, it's given them an excuse to change.
It has.
Yeah.
And you've seen the Morrison government hurtle back towards the centre in terms of running deficits. And so right now they're getting some decent repair from the high terms of trade, but it's still running huge deficits.
Yeah, and they're not getting a pushback though as well. The thing is, if they had just turned mid, without any pandemic, just turned mid-cycle and started running huge deficits, there would have been all these economists out there who had been trained on this whole deficits, and it's more armchair economists, I suppose, who are in this whole, deficits bad, but they're sort of going, oh well, there's a pandemic going on, that's all right.
All bets are off. Go for it. Open the taps.
And of course, key to this is the new role of central banks.
Yes,
who are all buying government bonds hand over fist. So, some of them argue they're not doing MMT, and you can get modern monetary theory, which is what this whole movement is derived from. Some of them argue on technical terms they're not doing MMT, but they're basically all engaged in it in one form or another. And that intrinsically undermines the whole fiscal discipline argument that dominated the political economy. Because if you've got a central bank saying, well, we need to get inflation demand up, everything up, buying the government's bonds, well, what on earth is the point in aiming for a surplus, at least over that cyclical period, if not longer term?
Yeah. Well, and you would like to think that governments could look at and say, if I can borrow at 1.5% over 10 years, or 2% over 30 years, and we're going to have inflation of somewhere between 2 and 3, I should be able to get a real return. Can I get over a 2% return when inflation is going to be 2.5%?
2.5%. Yeah. That's right. Yeah.
So can I get a negative 0.5, better than a negative 0.5 real return? You would like to think there is a number of projects out there that governments can say, yes, I can see better than a 0% return. So
yeah. So it is breaking here. Yeah, slowly but surely.
Very good. I think that's it for now. We might jump across to
one more on. So the last one, education.
I think it's more of a comment. Education would improve by a change of focus. It's better as preparation for market engagement by those it trains rather than a market itself.
Well, there's education certainly one where I think we've got some misaligned incentives in the Australian education system at the moment, which is it's all about
massively so.
Get students.
This is another huge upside from the pandemic.
Yeah,
is that collapsed the corrupting flow of dollars from international students that was really turning Australian education into little more than an economic rent seeker. Now there's a huge consolidation ahead in that. It'll take a long time for them to figure that stuff out. We've
still got misaligned incentives though.
We do.
Basically, we reward universities for having more students rather than for teaching students.
Standards.
Yeah, we do, and then you've got to figure out that funding model again. As economies reopen, I think that international student trade will certainly return, but simply not from China. That'll punch a big hole in it in the short term, and I don't think it'll run wild the way it did in the last cycle.
Still some time off though, you'd think?
I don't think that the Australian border opens for probably 12 months.
Yeah, which is well into the next year, university year.
But having said that, if you look at the economies that have done a really good job with vaccination, Israel, US, UK, they have all more or less killed the virus, and we expect them to be opening to one another over the next few quarters.
Yeah, right. Okay.
The UK especially, if you look at, Israel's outstanding. virus is virtually gone, even as it reopens. The UK is really good. Its virus numbers have collapsed as it reopens, and the US had a bit of a pop as it reopened, and it got the UK variant and stuff, but it's now reaching a tipping point of vaccination as well. And so it will come here eventually, and those student numbers will rebound, but it will be more difficult
to get them back up to the
with China
inclusive numbers.
With China missing.
Yeah.
So, and the Chinese were the really rich students as well. So, ones that bought a lot of money, invested a lot of property and stuff. So there were much more spillovers from the Chinese kiddies.
Yeah.
Yeah, fair enough.
Yeah, if you have to start tapping other emerging markets, then they're the ones that needed to come over here and
lift
and
themselves
work,
up, and work, and that's right.
And, yeah.
Okay, fair enough.
Yeah.
So cyclical winners and losers will kick off Chimerica.
Shall I?
Or would you like
Hang
to?
on. Oh, yes. So, well, I mean, we've basically covered Chimerica.
Chimerica is just to define that. This is a Niall Ferguson, I think. Yeah. So basically, he's talking about China and America as being sort of two sides of this economic growth where the US supplied the demand and China had the supply.
Yep.
And so it was all about the manufacturing shifting and it was sort of as one entity. There were two sides of it, but now it's a part about the election of Trump sort of showing that if you sack all your manufacturers and manufacturing workers and don't get them new jobs, then you actually end up with political issues.
Yep. Yeah, that's a good point.
So Chimerica reverses in effect. Gone is the model of the weak US outsourcing all of its industry, China just gobbling that up, and every time the US stimulates out of that, all it does is mobilise more Chinese labour. That's all started to reverse. So we'll have a US fiscally led cycle, and China running into all sorts of structural problems with its growth model. So,
and actually, sorry, just to define as well for people, the structural ones we're talking about are the big longer term trends. These cyclical ones are just the shorter term. There's still sort of 3 to 5 year type trends, but they're the shorter term ones as opposed to the structural ones, which are the 10, 20 year.
Yep. Okay.
So Europe,
sure.
We expect is it's going to have a nice reopening, catch up boom as it gets its vaccine case together over the next 6 months, but that's not going to last very long because it's very dependent on Chinese demand growth for its exports. It'll be somewhat supported by the US, where it's also got excellent exports, but Europe's wedded to this crazy mercantilist model that just embeds weak domestic demand, and there's no change coming on that front. They've got a little bit of fiscal stuff coming out of the pandemic, but it's dwarfed by the US.
Yeah.
So the US Europe is just another caboose.
Well, and the interesting thing for me politically from there is, I think a lot of that's driven by the sort of Northern European and Germany in particular, and you're going to see Angela Merkel finish up, and so I think what it'll be interesting to watch if anything changes in a big way.
Yeah, it would be great to see them swing around fiscally. But I think
unlikely to happen.
They're more likely to be the last redoubt of no MMT. No MMT here, please. And Australia's triple shock is where we see China slowing, and so obviously the terms of trade start to fall over the next 6 to 12 months and eventually fall quite a lot.
And slowing and reorienting as well.
Yes.
Certainly slowing a lot more in as we spoke earlier, that the old building houses and building infrastructure will slow a lot more, and then the technology side will pick up in China.
And those of you who've been through recent Australian history will know that we went through this once before in kind of 2011 to 2015, and the way that we managed to kick the economy through it was to run a massive housing
boom.
And sadly for us, we've run that to get through the pandemic, or at least coming out of it. And so within 12 months or so, we're already seeing the sort of baton change in demand in housing from first home buyers to investors, which is pretty typical of a cycle. First home buyers are first in, they get lots of fiscal incentives to go in and whatever, and then investors chase prices higher. The problem for that is once investors take over, it gives regulators a free hand to come down on the housing market.
Yep.
It's politically very difficult to hit first home buyers. It's very easy to do it with investors with macro-prudential policy.
Yep.
I'm not talking about rate hikes. I don't think we'll ever see those again in Australia, but I think APRA and the RBA will move on macro-prudential. 12 months might be 18 months out.
Well, when you say that though, for me, this TFF, and we're going to explore this more over the coming weeks, but there's this the term funding facility, which is set to expire soon. That will effectively be a rate hike.
Oh, it's a massive rate hike.
And there's.
I don't think there's a lot
danger
of people that have really thought that far ahead.
No,
Because this whole housing boom has been driven by sort of 3-year fixed-term loans, around 2%. And the moment the TFF rolls off, which is the cheap 3-year funding that the RBA printed for the banks to run these mortgages,
Yep.
it's about to be canned.
Yeah.
And so 3 years down the track, the banks have to refinance that money in markets.
Yep.
And so you've suddenly got an interest rate, and it's an embedded interest rate real adjustment in
Yeah, of
mortgage
course.
rates, where all these fixed term rates roll off to 3%
Yeah, that's right.
instantly.
What a jump.
And it's a huge jump. It's 50%
Yep.
shock on repayment shock. So that's embedded.
interest rate, sure.
Yeah, interest rate shock. So there's that, but I still think that APRA, it's a red hot housing market, and I think financial stability concerns will start to rear their head in the next 12 to 18 months, and so we've got this convergence, I think, of where our high terms of trade are going to come off just as regulators are forced to slow housing as well. Now they may elect not to, but that's, they don't want to be pro-cyclical, but I just think at a certain point, the financial stability issues will come up and they'll need to act.
Do you think there's a little bit of a timing issue here, and in the fact that it's like, okay, well, let's just keep our investment, keep the housing bubble alive, and obviously they've got a federal government trying to fulfil promises here as much as anything, as much as the other the fiscal side, monetary side. Sorry, but the other thing is obviously you've got this wave of immigration that's potentially going to once the country reopens again. So if we can sort of just hang on until as you mentioned before, we start bringing ourselves up with the majors in terms of vaccination rates and opening borders, and then we can just hand the mantle of debt over to the new Australians, as we're so good at doing in the past.
Look, it's certainly the case that if the Morrison government stays in power, say next March-ish, when we have an election, that's what they'll do. It's very clear that the political economy is turning quite hostile to that outcome.
Yeah. Yep.
Like lots of senior leading economists are now saying, do not revive immigration. What we need is wage growth.
Yep.
But I don't think the Morrison government gives a toss.
Gangster liberalism.
Well, the gangster liberals, yes. And so I think they would do it. I think Labor...
Who knows? Labor's not taking any policies.
No,
into
it's
the
very hard to say. They certainly would be more cautious on working visas, which would limit the ramp up.
To me,
but they may well be more generous on other areas of immigration.
Yeah. To me, Labor will avoid making any commitments to being anything except not the Liberals and at the election.
Oh, certainly before the
And
election.
so it depends on how hard they get pushed, I guess. If they get pushed really hard, I think they'll fall into line with we're doing whatever the Liberals are doing on the housing, so the whole thing won't fall over. And then if
that's it, they've already loaded in ways of changing, like they've already committed to, or at least suggested they'll review the RBA, its mandate and stuff. So there's always way of swings and roundabouts. They can get away with.
As long as they don't get pushed too hard on some of these issues, they might do something.
But the point is, it's going to be quite difficult to slow housing while the terms of trade fall and income gets smashed. And nominal growth. But it'll be difficult not to do it. Is probably the most important point here. They may be forced to do it. So that's three, and then the third element of the triple shock is basically just when we reopen our borders, which will be positive initially, but it's simply not going to come back the way it used to, because as a question earlier has said, just today China suspended all economic dialogue with Australia. Just today, as part of part of this ongoing soft power war that
Yep.
we've got going with them. And I really don't think tourists and students are going to come back. Like, I think that's just the next hammer to fall. And so that's a massive driver of all sorts of activity that simply won't be here as we reopen our borders that others will have. And so it becomes a quite difficult cycle.
Yep. Okay.
And part of that, at some stages you say, well, it's almost not even, from China's perspective, I think it'll end up being not even as much about punishing Australia as about showing other countries.
That's right.
Yeah,
Muscle
say New
flex.
Zealand, for example.
Yeah.
This is what happens. This is what happens to countries who step out of line. So
Yep. Become the martyr. We've got some questions, but there's one here just from James. Thank you. Was Janet Yellen correct yesterday?
was that when she was walking back her statements? What was?
Well, she walked it back because it freaked markets out. But yeah, I think she's right.
Yep. Okay.
Sorry, let's define what.
Yeah, sorry,
Which
just
one are we
give a bit of
talking about?
context.
She said they may need a few interest rate hikes to prevent overheating with the fiscal tailwind. I mean, that's just sense.
Yeah.
Okay. All right.
I'll add that I don't think that the US is going into a self-sustaining inflation cycle yet. Like, they're clearly got some quite severe supply chain inflation.
Yeah. But the other thing was there was So there's very temporary ones that under Trump unemployment got under 4. Was it? Was it or around 4?
No, I think under 5. I don't,
5. Maybe there's a 4.
I can't remember.
Anyway, unemployment got a lot lower than they expected, and they were expecting all this wage inflation, which didn't come.
Yeah.
And
Surprise,
so
surprise.
there's a lot now. It's questions about how low do you really need to get unemployment to get before you actually see inflation. And
Yeah, I think we'll get there this cycle. So I think there'll be stronger inflation in the US, stronger wage inflation and stronger inflation in the coming cycle.
But we're not talking 8% inflation and
No, I don't
away.
see that.
Yeah.
I think they've got a pretty good handle
How that works.
on how it works. Yeah. So, sorry, what was the question?
No, I think we pretty much got it there. Jenny Ellen correct yesterday.
Yes, more or less. Yes.
Thanks for that. And emerging markets, just finally.
Well,
rounding
that's a
it
good
out.
jumping off point for this emerging markets going to hell because US inflation will be stronger than elsewhere, especially emerging markets, because I think they're going to sink with Chinese demand as China slows in its structural changes. I think before too long we'll just get a big commodity deflation cycle the same way we did from 2011 to 2015, and that takes emerging markets down with it. And then you've got the US leading with growth and inflation and yields, and that gives you a strong US dollar.
Yep.
Right, which then starts to pull capital out of emerging markets.
Right.
So they're taking a demand hit from China and taking a capital hit from the US.
Yep.
And that is precisely the circumstances that led to the EM meltdown in 2015 and various other emerging market crises. In fact, the Asian crisis was similar with a runaway US dollar. And at this point, it's very difficult to know how far that goes, but we can see the emergence of the same dynamics. And so there's a lot of people saying get into emerging markets. I just say get out of emerging markets.
Right. Yep.
And part of our argument is that Australia is pretty close to an emerging market.
Yeah, I was just going to say
in terms of the way it reacts.
You explained what an emerging market was and the effects there, and it just sounded so similar to the Australian. What we were just talking about with the Australian one, and leading into obviously the dollar as well.
I was mulling the other day if we need a third category specifically for Australia, and that is devolving markets.
Yeah, but you could probably throw
Formally developed, turning emerging.
Well, yeah,
You know.
but commodity dependent. Developed markets.
Yeah.
And so you can throw Australia, you can throw Canada into that same one, and you can sort of look at whether you put Norway, depending
But some
upon...
of them have managed the devolution better than others.
Yeah, so Norway, for example, is, yes.
Yeah, and
is
Canada's done all right as well, but largely just, I think, through geographic proximity.
to the US, yeah, absolutely.
Gives it a big leg up for manufacturing. So, but yes. Yeah. So,
Okay.
All right.
Questions about...
We've got a question here around from Greg. Thank you. Who will buy the debt in the future if central banks are cornering the market? Thank you, Greg.
Central banks.
Central banks, more
Yeah.
central banks.
Well, you can kind of see a doom loop there if you want to. But I'm not particularly concerned about it.
Japan's probably an instructive example where they get to the stage where there's just an underpinning of the left-hand borrows money in the right-hand. You take money out of the left-hand pocket and put it into the right-hand pocket, so the government can spend it, and the net effect is, you could look at the headline Japanese of 200 and whatever 20 or 30% of GDP is debt to GDP, or you can just sort of get rid of all the
zeros,
the two offsetting bits, and go, well, it's actually more like 70 or 80.
Okay.
So it's much more.
Okay, interesting. And do you feel like that I guess the developed world ex Japan are heading down that path?
Yeah, I mean, obviously that's now being weighed more. Fiscal policy is weighing more against that now, with this shift in towards MMT.
Yeah.
But the structural deflationary forces are still very big. So,
and what actually just a thought back on the emerging market side as well is one of the real benefits. So where Australia steps out from the emerging markets is not only having a well-educated workforce and relatively flexible and all that type of stuff, but we can print our own currency. That's a big difference for Australia.
Right. Yeah.
Whereas in a lot of these emerging markets, they just can't print. They're reliant upon the borrowing of foreigners, which is where the trouble comes from, because they have to borrow in US dollars or another currency, and then US dollar gets stronger. That increases their debt, and it's very pro-cyclical.
Yep.
When things are going well, they go really well, and when things start going badly, they can go really badly.
Around, and obviously Europe sort of sits slightly in that boat as well. as a global power,
individual European countries. Yes.
Yeah. But then, so Australia's got that we don't have the same. We don't have the same outlook. Well, there's certain parts where we're similar to emerging markets, but there's parts where we're very different as well.
Yep. Okay. Very good.
So we come to the pointy end of the discussion, I guess, now, which is, how does all this boil down for assets?
Yes.
And so first up is debt, bonds, and I think this is the end for the immense bull market in developed economy bonds.
Right.
That's driven a lot of stuff for the last 30 years. That said, I don't think we're about to blast off in some new inflationary regime where they just keep getting sold off. I think basically bonds will become a trading asset.
Yep.
You'll have to be moving in and out with cycles. And so we'll effectively yields will bounce along the bottom.
And partly that's because the debt now is so massive in corporates. Households in Australia, not as much elsewhere, but governments as well. With that, you just can't get inflation. If you raised interest rates to 5%, you'd send governments and corporates and households broke.
Yep.
And so that's the limiting factor of why it won't go there, is because central banks will have to keep rates low in order to not send everyone broke in the economy. And as much as there's this whole sometimes you see this whole philosophical bit about but inflation's running high, and then they'll have to put rates up to this level. Is like, well, they'll put rates up to the stage where to try and bring back inflation, but no one's going to send their economy into a depression in order to control inflation. To
right it. And just on that, so you mentioned there, which is quite interesting, so the movement to debt being effectively a tradable element now, I guess, in portfolios and for people, the way people think about it. So when you're saying that, are you looking at it in the frame of the various kinds of debt, or are you looking at say duration in a in a corporate bond, in a federal bond ladder like ourselves that we run here?
Well, for our own purposes, when we're sort of somewhat run a 60-40 model, although we have plenty of scope to juggle it. I'm more talking about duration.
Yeah.
Flipping from here to there. Like, for instance, we're hiding right under the RBA skirts at the moment.
Yep. In the short end.
Yeah, the short end of the curve, because we can see that the US inflation burst is likely to back up yields a little further, and that'll filter down into Australian yields as well. But if we see what we think is coming, which is this China slowdown and structural restructuring, then Australian bonds are going to be a bargain at
Yep.
some point in the next year or so. You know, as those longer end yields get blown out, and then we're hit with the terms of trade shock.
Yep.
Then, you know, there are millions of other factors here. You know, wage growth and wage inflation, and whether immigration comes back, and
Yeah.
you know, who's in power, blah blah blah.
Yeah,
But
all those narratives.
I can see a case where going longer duration in Australia will be a good bet.
Pay off. Yep.
Yeah. But the point is, you just can't sit and forget on your bonds
Yep.
anymore.
And the corporate bonds are I guess we're talking about government bonds in terms of what we're saying
Yeah.
here. Corporate bonds are very different in that there's a risk of default.
Yeah.
And so you've got to, they will react in some ways similar to corporate government bonds, but in a lot of ways similar to equities as well.
Yeah.
And so you're sort of caught in this middle part where, you know, we've basically made the decision within our own portfolios that we'll take the equities, we'll take the government bonds.
Yep.
And the corporate bonds are something, you know, people want to play with, they can do on their own.
Yep.
But with the view that we don't think they're an asset you absolutely have to own as part of your core, which is, you know, we're trying to run the core assets at Nucleus, and so so we're sort of happy that we can get the exposures we want by just playing with those two assets, and because you've got the pure elements, whereas in the corporate bonds you're sort of getting a bit of both.
You are, yeah. You're going to get that huge correlation risk. And I guess, yeah, we've got plenty to play with in duration anyway. So, all right, that's good. We'll jump across to houses.
Yeah, well, I touched on this already. Houses, in terms of, we're obviously flying along at the moment, but there are some embedded risks. 3 years out certainly for a rate reset.
Well, but also the biggest one, if the TFF stops in June.
It doesn't become an ETFF or something, extended term fund facility.
Yeah, but if it stops in June and banks all of a sudden can't lend at 2% anymore, they're lending at 3 and 3.5%.
Yep.
Then there's a lot of people who can no longer afford to buy houses. You know, there's a lot of people who are buying houses now because, especially at the first home buyers, is because the bank of mum and dad gives them the deposit, and they can afford the payments at 2%.
Yep.
But if all of a sudden
it
turns into bank of mum and dad can still afford to get the deposit, but
that's it. The
enough
banks are not
increase.
having any real funding pressures at the moment. Like, I wouldn't expect to have a huge shock straight up front. Like, they've had a flood of deposits and stuff, a lot of other cheap funding.
Bit of fat in there.
Yeah, I think there's a bit of fat. So I'm not sure what see. Like, I think fixed rates are bottoming. Yes.
Yeah.
But I wouldn't see them just catapulting up to 3.
Yeah. Anyway, I think we're going to be looking at this more over the next coming weeks
sure.
anyway.
Yeah.
So we're in the good times for house prices right now. Inexorably there's going to be tightening.
Yep. Just on that. So, do you think there's an opportunity in front of us where you've got a pro-housing government like Mr. Morrison's, and then you've got an RBA deciding whether or not they're going to pull the trigger on the TFF, and then it suddenly turns into like this pay-per-view event in the Canberra Octagon?
I actually think the RBA is pretty good at seeing off political pressure.
Yep.
And this is, I mean, with it, you got to take that a bit with a grain of salt. Okay, like you accept there are the certain fundamental principles in Australia, which is like house prices only go up, right?
Yep. Yeah.
but within that, the RBA will tighten if it thinks it needs to tighten. I think APRA is an absolute jellyback, sellout, corrupt, hopeless mob. But I think as well that APRA really is just the plaything of the RBA, even though they do have this structural division. I think if the RBA rang the APRA and said, we want you to tighten, they would.
Yep.
So, I mean, it's clear the RBA and fiscal authorities are already in attention.
Yep.
And I think that'll probably get worse. Yeah. If Labor got in, I think they'd be much more hawkish on house prices, even though they'll say they're not
Yeah, sure. Yep.
beforehand, but they probably will be because they've got more upside in it, much younger voters, what have you. So, I mean,
It's interesting as well as to whether they've got the intellectual heft, let's say, in the current front bench of the coalition to actually embark on an economic argument that took hold of, like, whereas I think, in the past, say, Paul Keating or even Costello, I think had enough gravitas and enough economic knowledge to embark upon a campaign of whatever to try and convince the RBA of what they wanted.
Yeah.
Whereas I'm not convinced that they could at least get some journalists on their side to help write their case up. And I suppose you probably could get some
I don't think
journalists.
so. I mean, it was pretty clear in 2016, 17 that the government didn't want APRA to tighten on property.
Oh, APRA, yeah, but that's the point about whether you get the RBA to reverse its. As I said, if it's pressure about, could you get pressure from the government to force the RBA to keep something on that they didn't want to? I'm saying I can't see them.
No, I don't think.
Embarking on an intelligent enough argument that captures that.
No, I don't think so.
Enough economic commentators.
Yeah. No, I think the RBA will do what it thinks is right. And Phil Lowe probably more than previous governors, actually. I think Ian Macfarlane was definitely a little bit politically driven. Glenn Stevens was pretty good, but I think Phil Lowe's a bit of a
The steely hand.
a little bit, yeah. Don't get me wrong. I don't agree with everything he does, but I think he does what he thinks is right.
Yep.
Yeah. So
Very good. Okay.
his career history is very much along those lines. He's never been afraid to stand up to the sacred cows of the day. And so anyway, there are going to be there will be various clamps put on housing over the next year or two. I think, and so we're in the glory days of it right now. The only other big risk that's worth mentioning here, and we mentioned in passing earlier, and that is, will some of these big tensions in globalisation and liberalism come to bear in a war in Taiwan? Guys like Chris Joy are really hawkish on this, and I disagree. I don't see the point. I don't see in whose interest it is yet. The CCP doesn't need to panic that much, because the immense risk, and I think this is very, very real, and I think this would probably happen, is the world would respond with economic containment if China invades Taiwan. That's assuming the US doesn't fight the war, and I don't think they would. They were actually out last night. Kirk Campbell, who's the Indo-Pacific point man for Biden administration, in an interview with the FT, said they're all for strategic ambiguity over Taiwan. They're not going to give them a security guarantee, and that they'll arm the teeth out of the place. But it's a proxy. It's not a direct interest.
Yep.
And the simple fact is, just about every strategic modelling of that war is the US loses. So why fight it? But the point is, it would be an economic war, like a Cold War, basically. And Australian iron ore exports would cease.
Yep.
Overnight, and LNG, just about everything.
Yep.
And so that obviously comes with a massive shock. But at the same time, we're talking about the TFF and how that's going to deliver implicit tightening as it rolls off. It's also there for the next crisis. The RBA can go back to printing cheap dough for the banks anytime it wants. And as we've noted many times over the last sort of 6 to 12 months, if you look at other jurisdictions, like Europe, for instance.
Europe's TFF started in 2016, 15?
No, I think...
They saw the pandemic coming.
2014, it was in the European crisis, and TLTRO, and it's just gotten deeper and deeper and worse and worse until their mortgage rates are 50 basis points and stuff. So yeah, I'm not saying that housing's about to crash or anything, just that I think they will be forced to tighten and slow it, and we may see some price falls in a year or two, but they've got these other options to support it. So
what was said though about all these markets though is the biggest risk for all these markets is policy error, and so and if you get central banks withdrawing support too early, then that's the policy error. All governments withdrawing the fiscal support, and that's what markets are really they're expensive on the base, but we're getting some growth through that's making them less expensive. But the issue is you have to keep relying on government support being there and central bank support. And so if that's the biggest negative case is if you're seeing policy error that
Shaking the confidence and
Time
everyone's
step out.
starting to realise what they're paying.
Yeah,
They're paying
which
for
is the
things.
key tension for equities.
Yeah, moving on to equities,
The
actually,
next
just
one
to,
on- next
finish
cab
us
off
off.
the rank, and
Yep.
and I mean, Damon's basically summed it up there. There's huge profits growth coming through, and I mean, we know markets are incredibly overvalued, but there is immense profit growth, and it looks like it's going to continue for a year or two more. We're starting to get
the markets are slightly cheaper now than what they were earlier on in the year, even though they've run up another 10%.
Just purely off
because
the-
profits have grown so quickly.
Yeah, wow. Yep.
and we're getting what do you call it?
Reports.
Guidance. Yes.
yeah.
Corporate guidance is coming back in. It's a very positive. And my own view is as well. I think inflation. Some of these inflation factors are going to fade pretty quick. Supply side stuff, and then commodities after that. And so, that's going to support margins as growth starts to slow.
Yep.
So there's a couple of good years left in the profits boom, I think, and so that's going to bring down valuations all by itself. But then there is the tension with policy risk if they over tighten or whatever. There's definitely a possibility that some of those high multiples are going to get crimped.
And when we're talking this, we're talking on a broad market basis,
Yeah.
as opposed to an individual sector sort of. And
There's definitely some
Yes.
sectors. Well, actually, it's the profit growth across sectors is actually being remarkably consistent across sectors.
right.
But there are certainly some sectors that are doing worse and better than others, and there's ones about. It depends on whether you're looking at growth or whether you're looking at where they are versus prior to the pandemic. Something like retail, for example. If you manage to shift a lot of it online, you're doing great.
Yep.
If you didn't, you're doing really badly.
blowing up.
So,
Yeah, right.
but having said that, you're doing better than you were last year, first quarter last year. So the growth rate's good. But if you said, okay, well, how am I versus the first quarter of the year before that?
Yep.
Now you're down. So yeah, it's sort of it's not just the trajectory. I guess the thing for me is looking back at first quarter last year, and even more so when we're going to be looking back at second quarter.
Yep.
You just sort of almost have to throw that away as analysis and say, let me look back 2 years, or let me look back at
Maybe there's
other
an outlier.
factors, and just say the growth rates are just a bit meaningless in terms of if you fall from 100 down to 25 and then you bounce back to 50,
Yep.
you've fallen 75%, you've doubled now, and but you're still half where you were.
Yeah, sure.
Whereas somebody who only fell to 50 in the first place, but then rose 20%.
Yep.
So you look at the growth rate going, oh, this guy doubled and this guy only grew 20%, but the guy who grew 20%'s getting closer back
bigger.
to
Yeah, that's right.
where he was than
Okay.
wasn't.
Fantastic. Before we jump to this chart, was there anything final on the equity piece or anything else? Or just...
No, I guess that's it. I mean, I just think there's this this ongoing tension between stimulus and profits growth.
Yep.
We could go on about factor rotations, certainly. Like, for instance,
Could be another show's worth.
well, there is a whole show in this, but for the time being, at least, there are areas of the market that are also deflating.
Yep.
Very quickly. Tech and growth, especially the Wild West.
Yep.
Of those are coming apart. Actually, it's a tech wreck,
Yeah, sure.
and that's all driven by the rising yields in the US that we've described about. What's driving that, and if you think that those yields are going to persist, then that deflation is going to continue, and so that's going to take some multiple out of the market as well. But then at the same time, you've got a rotation into value stocks that are really prospering from looking shorter duration.
Yep.
And so you're definitely under the bonnet in equities. These various cyclical and structural forces that we're describing have a big effect on potential returns.
Absolutely.
Yeah.
So probably not a bad segue just quickly to our chart. We don't like to toot our own horn too much, but we've got our international component of what we do, which is Core International is the name of the portfolio. We'll put that up, I guess, just to provide an example of international exposure, but also just to highlight the difference, I guess, in particularly the ride last year.
Downside protection.
Yeah. So and look, the big one obviously that stands out is the year that was in 2020, Damien, and I guess what. In your eyes, why was it that we were able to outperform? So obviously the Core International is fully invested in the market. However, it's not in the whole market.
Yeah, that's right. It's the question about saying about what sectors you're invested in, and and how you're looking to get your ride. Like, I mean, there's lots of funds out there that are all about the growth. And what's Kathy? It's her huge growth one.
Talk about ARC.
ARC, that's right. The ones who they're buying anything that's growth, I'll buy it.
Yep.
And you're going to get a much bumpier ride in those ones. The market will be up.
I might add, she's getting absolutely smashed
At the moment, yeah. But the market, so the market will be up 20%. They'll be up 50%. But then the market falls 10, and they're down. 40,
so they're at the choppier end of the equity ride. Yep.
And we've got a big focus on switching between quality and growth. And what we're trying to do really is limit the downside and capture as much of the upside as we can. And so and with the view that we're running core portfolios for people, and this is the stuff that you don't want to wake up and have to worry about your market, your portfolios falling 50% or jumping 50% the next day. And so, so that's what we're trying to have those ones to say limit the downside and get as much exposure as we can to the upside.
Fantastic. Very good.
And I'll just add to that. I mean, obviously where all of this discussion comes to bear is upon the Australian dollar, which has massively underperformed in terms of where you'd expect it to be with commodity prices where they are, largely because I think of many of the factors that we've discussed today. But as we see this cycle transpiring in the manner described, then we expect the Aussie to fall a long way as well. So you've got a combination of better growth opportunities offshore, with Australia quite challenged once we get through. At the moment, it's about as good as it gets. At the moment, we get through the catch-up growth period, and then a falling Aussie dollar to really accelerate your offshore returns.
Big tailwind. Yeah, wonderful. All right, very good. Well, thanks, gents. We've had quite an extended session today, so thank you for your time, and it's a great topic, and I'm sure we'll have plenty to add to those drivers going forward. We'll jump across to our viewer question of the week. Where do you go? It's always interested to where our listeners are thinking for your reliable international exposure. If the themes of today resonated with you, and where would you think to go to pull the lever on some international investments? So thanks, gents, for tuning in. We'll chat now about coming up next week. We do take a look at the exciting world of electric vehicles and the technology driving them with Canadian energy aficionado, as I mentioned before, Paul Martin. Paul is a chemical process development expert and has written extensively over the years on various use cases and the potential of alternative energy sources, and he's even converted his own car, petrol car that is, into an electric vehicle as a proof of concept. We chatted to him yesterday as a pre-record, and we spoke about Elon Musk battery technology and whether hydrogen is useful or being sold to us by useful fools. So
and he's very much, I guess the preempting is he's debunking the ultra positive views of
hydrogen,
of renewable energy, but then also the ultra negative ones as well. So it's quite interesting to see, as somebody who's involved in the cutting edge, which technologies he's not seeing future for and which ones he is.
Absolutely. Yeah, it was a wonderful chat. Could have probably gone on for another hour, but we'll look forward to getting him on again. So tune in next week, Thursday the 12th of May, 12:30 p.m. for what promises to be a big show on the most electrifying new developments of the 21st century. Ha. Thanks again to all those who have watched in live for another great episode, and all of those who have asked some terrific questions. Hope you've taken away some great ideas, and if you haven't already, please click like on the video now to give us some feedback. If you'd like to see more of our content, head over to nucleuswealth.com/content to stay up to date on news from us. Follow us on social media, and finally, if you know anyone who'd get something out of today's episode, let them know about it, share with a friend, and help our show grow. So thanks again for tuning in from myself, Tim Fuller, and the team, and we'll look forward to catching you with the next one. Cheers.